All right, it's 12:03, I think. So why don't we get started? Okay, well, a warm welcome to everybody joining us today. We are very glad that you are taking time out of a busy weekday to join us for this very important topic of making sure that your families are secure and taken care of no matter what happens. We will try to keep the presentation relatively short and sweet, maybe 30 minutes or so, and then we'll have time at the end for some questions. And so, definitely feel free to ask us questions during the Q&A if you can stay, and if not, we'll offer you ways that you can reach out to us after the fact and chat one-on-one. Before we dive into the content of the presentation today, Sage and I are just going to share a little bit about ourselves and our businesses. We both, and we really bonded over this, we really pride ourselves on having very relational relationships with our clients rather than transactional. And so it seems particularly fitting for you to understand a little bit about who we are and why we do what we do. So Sage, take it away.
Yeah, thanks, Ariane. So brief background on myself. I grew up in Murrieta, California. I had two brothers. I was the middle child, and my parents ran a small business growing up, provided for all three of us kids and then some. And naturally, being surrounded by a lot of blue collar folks, I realized that many families had not properly saved for some of their financial goals, including retirement, funding their kids' college education, even though it was very much their goal to do so. And I was inspired from a young age to dramatically improve my financial literacy. And so I began reading as many personal finance books as I could get my hands on, and eventually went to study finance at Cal Poly San Luis Obispo on the Central Coast. And being an analyst and co-managing the university's endowment fund, I really learned how to make great investment decisions. I was obsessed with the stock market and following markets. And so that, inspired me to want to work in the industry. And I started working at Gerber Kawasaki Wealth Management here in Santa Monica. And I built my clientele and am continuing to grow. And recently I became a certified financial planner. So it's very exciting to bring all this knowledge to my clients and those around me. And, ironically, what really motivated me to become a financial planner at the end of the day, and what I believe is even more important, is kind of the behavioral aspect of money and how we view it. I always like to ask, why is it that we make the decisions that we do as it relates to finances, and how can we, truly achieve pure financial independence and improve the financial situation that we are given. So, my goal every day is to help people make solid financial decisions for their families so they know they're going to be taken care of and can live their best life with the least amount of stress possible and really achieve that maximum financial independence. So that's what really motivates me. And yeah, we're always here to help.
Great, Sage. And don't forget to advance the slides so they can see that great slide about you.
Thanks, Ariane.
Yeah, sorry, we were managing some tech, so
some technical difficulties, but we're on it.
Yeah. Great, thanks so much for sharing, Sage. I love your passion for helping your clients, so it's one of the reasons I'm so excited to work with you. Okay, so my name is Ariane Sims, and I kind of like to say that I have an East Coast sensibility and a West Coast disposition. I grew up in New York City and first came to California for college. I zigzagged between California and New York a couple times, with some stops along the way in North Carolina for law school and New Mexico for work. But I remember when I was 16 years old, I had an incredible opportunity to volunteer on a Lakota reservation in South Dakota. And I learned so much about history and challenges that people face. And I realized I really wanted to go to law school and help people navigate challenging situations. I worked in a variety of nonprofits through the years, and then graduated from law school with a mountain of student debt, which Sage can help your kids avoid, and he'll talk about that a little later. But I ended up working at a large international law firm in both the New York and LA offices. And while I was working alongside some of the most brilliant legal minds out there, really, our clients were all huge corporations. And I really missed that personal connection that I felt, when I was working more in the nonprofit space. So I worked in some smaller firms, and then after some time, I even left the practice of law for a while to pursue some other interests, doing environmental media work. But when I was pregnant with my son, who you see in that picture, Mateo, I began to look into estate planning for our own family and realized I found my calling. I absolutely love what I do. And I was a former litigator. So doing something where I'm working collaboratively with people, helping people navigate situations, questions that they have. And mostly I work a lot with parents with little ones to make sure that their kids are always in the hands of those they love and trust, and that the assets they've worked so hard to build are protected for their kids. And lastly, some people might ask, or often ask, why I name my practice 7 Generations Law. And there is a principle in Native culture, and again, I've worked with a lot of tribes doing work in different capacities. There's a principle that for every action we take today, we have to consider its impact 7 generations into the future. I love this because it so resonates with the work that I do every day in terms of leaving legacy, not just financial and legal, but also personal. And I'll touch on that a little later. And also my passion for environmental stuff. So anyway, with that, I'd love to pass it over to Sage to kick us off with our actual substantive content now.
I love that. Thanks for sharing, Ariane. So let's dive into why we're here today. So our goal is to arm everyone with the important education and knowledge so that you can make the best choices for yourselves and for your families by carefully using financial planning and legal planning. So here are the topics that we'll be discussing today. So first and foremost, it can be a very simple thing to do, but it's very important. Oftentimes gets overlooked. Make sure you and your loved ones receive your money and assets appropriately and name your beneficiaries. Don't let the courts end up deciding where your money goes.
Okay, so you may have heard stories about what happens when celebrities, such as, to name a few, Aretha Franklin, Philip Seymour Hoffman, Prince, they've passed away without a proper estate plan. They left a super expensive and protracted mess for their loved ones. But here's the thing. Trusts, especially we're talking about revocable living trusts, are not just for the super wealthy. In fact, I argue that they're even more important for regular people, because if you don't have one, it eats into so much of the hard-earned money that you've made. And it really boils down to this. If you care at all about who gets your money, how and when they receive it, and this is particularly important if you have minor children or beneficiaries with special needs, then you need a comprehensive estate plan that very likely includes a living trust, as well as a pour-over will, a durable power of attorney, a healthcare directive, and if you have minor children, a whole kids protection plan that I'll be talking about a little later.
And then the next big one, retirement. So Ariane, what happens to my clients or really anyone's paycheck when they retire?
It stops.
It stops, exactly. So, and I know it's intuitive, but sometimes we overlook that as well. It's prudent not to, rely on Social Security to replace our income. And contrary to what most people believe, retirees actually tend to oftentimes increase their lifestyle in retirement, or at least experience an increase in their overall expenses. So as an advisor, I want you to enjoy, your final phase and all the fruits of your labor and hard work that you put in throughout your life. And pure financial independence really is a beautiful, beautiful thing. And it allows you to spend time doing whatever you love the most.
Great. And so, okay, I'm also going to be touching on a little later on why the manner in which you hold title to real property matters a lot when it comes to minimizing or even eliminating taxes.
Great. And then another big one, life insurance. So make sure you're protecting your loved ones. Most people rely on their income to support their current expenses, such as a mortgage, food, groceries, daycare for their kids, etc. And so, I'll pose the question: what would happen, if God forbid something happened to the primary income earner for your household, if they were to pass away tomorrow? And having life insurance protects you protects your family so they can receive money and continue to live their life, and just really ease the overall financial burden in a scenario like that. And then next is the 529 college savings plan. So we're going to talk about how to help plan for your kids' education. And believe it or not, college tuition inflation has increased faster than inflation in general. I know, hard to believe, over the past decade. And so it is, it can be expensive for young adults to attend college these days, very expensive. And, many spend the majority of their career paying off student loans if, there wasn't proper planning ahead of time. And so if you want to set up your kids for, really educational success, a 529 plan can be one of the most flexible savings plan for that goal.
Yeah, that's great. So speaking of kids, most clients come to me because they have minor children they want to protect if something were to happen to them. The catch is that most traditional estate plans include really only one reference to protecting the kids, and that is naming a long-term guardian in a will. Now, that's better than nothing, but even this approach has way too many gaps and can leave the kids at risk. So as I mentioned, I'll be sharing a little bit about my kids protection plan, which is a comprehensive approach that I take to ensuring that your kids are always in the hands of those you love and trust, and that your assets are used for their needs in alignment with your values and principles. So with that, let's get started, Sage.
Great.
Oh yeah, and then we'll have some Q&A as we mentioned at the end. So have your questions ready.
So we like to kind of view your overall plan as the house, right? So we're going to jump into that house and break down those different parts for you. So, as we were just talking about beneficiaries, again, this is a very important topic. And last week, I had a financial planner's worst nightmare, essentially, in my dream. And again, this was a dream, to reiterate. My client had passed away without a named beneficiary, and their money went through probate. I remember it was a mess for the family. And one of the most simple and basic things that you can do is to make sure you name a beneficiary on your account. This could be a spouse, preferably a parent, a sibling, a trusted contact, or even a fiduciary. You name it. And literally you get to name your beneficiary and where you want your money to go. And so think about how important that is to you and for your loved ones to receive your money if something were to happen to you tomorrow. While naming a primary and contingent beneficiary can be a simple and basic task, as I mentioned, like I said, it's often overlooked. So, reminder to add beneficiaries to your 401k and things like that, which I'll discuss later. And depending on your situation, it can be more complex and require more expertise and planning. And so, Ariane, can you tell us some stories when it comes to selecting beneficiaries and helping families with their estate planning?
Yeah, well, I will say that your dream was a client's actual nightmare. I have a friend and client who, when he was little, his dad unexpectedly passed away. And good for his dad that he had life insurance, but it turned out he had never updated his beneficiaries, and his ex-wife got the money. Okay. This is a terrible problem and one that could have, really been avoided. So it's so critical, as Sage was talking about, to have people named and to make sure that you update this information, that you have the right people named. Okay. Another point that I'm going to touch on a little later is minors can't legally inherit assets. So if you name minor children as a beneficiary on life insurance and retirement, and I do see this happen often, those assets could end up going to probate. So it's not just naming a beneficiary, it's making sure you name the correct type of beneficiary. Okay, so probate. What is probate and why is it so notorious? So probate is a post-death court process that your loved ones have to endure after your death if you don't have the proper estate planning in place. And it is notorious, and this is, by the way, even if you have a will, okay? A will does not avoid probate. So let's, I think, go to the next slide, and I can share with you why it's just so notorious. So one, probate is very expensive. Here in California, there's all these statutory fees and costs that we estimate at the end of the day, if you have to go through probate, it costs about 5% of your estate's fair market value. And let me repeat that, fair market value. So say you're a first-time homeowner, you just put, maybe say you have $100,000 down in a house of $1 million house. If you pass away, it's going to cost about $50,000 to probate just that house, okay? Even though the equity you have in it is only $100,000. And then add in your other assets, bank accounts, brokerage, businesses, things like that. Probate can easily be super expensive. The next reason is that it's really long. Even uncontested probates can take generally 18 months to 2 years, sometimes even longer. COVID slowed things down, and it just takes a long time for things to wind their way through the court process. And then finally, it's a court process that's public. And so if you have young or otherwise vulnerable beneficiaries, people can prey on them and really take advantage of them. So these are all the reasons why probate is just, we want to avoid it at all costs. Okay. Oh, and one more thing to consider if you have minor or young adult beneficiaries. Again, as I mentioned, minors can't legally inherit. So what happens if minors are, you know, the heirs under a probate? Well, a judge is going to appoint somebody to manage the assets for them. And then at 18, they get it all. I don't know any parent that would want their kids, and especially as the mom of a boy, they mature a little later, at 18 to get life insurance policies, real property, all those things. It's not in alignment with how we would act as parents if we were alive. And so we certainly don't want that to happen if we're gone and we're not there to guide them. Okay, so probate's terrible. We want to avoid it. But the good thing is that there's a much better way. And that is with living trusts. Okay, so by creating a revocable living trust and putting your assets in it, you can avoid probate. And I like to use the analogy of a wagon. So it's, you know, like the wagons we go to the beach or put our kids in. During our lifetime, we can put property in and take it out, put our assets in and take it out as we choose. The things that we put into the wagon or for the living trust are real property, cash accounts, non-retirement investments, and business interests. And so long as it's in the wagon, it avoids probate. Now, the idea is if you're dragging that wagon along and something happens to you and you drop that handle, the person you name the successor trustee can just pick up the handle and keep going without the need for court intervention. So it's faster, cheaper, more private, all the things, right? Okay, and so I talked about the things that we put in it. Again, real property, cash accounts, non-retirement investments, and business interests. The other big assets that people have are life insurance and retirement. Now, we don't put those in the trust. Those pass by beneficiary designation. But again, we don't want to list minors. So what we do is we actually make the trust the beneficiary of the life insurance. So if we have a married couple, if something happens to one spouse, the life insurance goes into the trust for the survivor. And if something happens to both parents, it just passes down into the funnels through the trust for the kids, right? And then around retirement, we make, in the event of married couples, we make the spouses each other's primary beneficiary and the trust the contingent. And if there's a single parent, then we can just make the trust the primary beneficiary in that too. So the idea is everything flows through the trust to avoid probate, and it's there for the children. So speaking of retirement, Sage, I know you've got some good info to share.
Yep. So one of the biggest areas I focus on with clients is retirement planning, because for many, it's their biggest financial goal. And the consensus of what retirement actually means, in my opinion, which is based on thousands of conversations and research that I've done and all those conversations with clients, is having pure financial independence. What does that mean? It basically means having the flexibility to do whatever you want, when you want, without having to let money deter you from doing that activity. And the reality is, many do not save enough for their lifestyle that they want to live in retirement. And I just want to pose a question to the audience. So do you think that Social Security alone provides enough income for the average person's retirement? I'll let you answer that one yourself. But my job as a planner is to really assess a client's financial and life situation and their needs, and show how we can enable you to have successful retirement. It's rare that families are fully utilizing retirement accounts that are available to them, whether it be a 401k, a 403b, a Roth or traditional IRA, SEP IRA, simple IRA, pensions, and the list goes on and on. But what makes sense for one client to use may not make sense for another. And for example, I see many young individuals contributing to what's called a pre-tax 401k, which is how most people contribute to their 401k, which is great. And getting started early is amazing because of compounding interest and all of that. But for a financially driven person who has a bright career ahead, it may make sense to contribute to what's called a Roth 401k. So instead of doing pre-tax, you're doing Roth. And although with this option, there's no tax deduction for contributions made into the plan, this would allow the money inside the plan to grow tax-free for retirement. And instead of being taxed later on, as you would with pre-tax assets, the money in the plan can grow tax-free. So as you can see, the rules of each retirement account were drastically different from each other. And it's really our job to determine what's most suitable for you. And so it differs from tax benefits to, and when you get a deduction and when you don't, to investment choices, income phase outs for being eligible to even contribute, distribution implications, penalties, and even how the rules work for inherited assets and retirement accounts. So I'll give you, another example of how a scenario might play out. So if, my client and I determine that they have enough assets to not run out of money in their lifetime, and they want to maximize the amount of money that their children will inherit, my mind immediately goes to, number one, how can I help, the future generation save more money on taxes, right? I may want to see more Roth funds, meaning already taxed dollars. And number two, how should we adjust the portfolio and the investments to produce more long-term growth as opposed to retirement income? And my point is, my recommendation for this family is going to look much different than the family who needs income to live off of and preserve their retirement assets for themselves. And so it really depends on the financial situation, and your goals. But if you think, artificial intelligence and robo-advisors in today's phase, at least, can listen, understand, consider and weigh different options for you, and really help implement all of your family's retirement plans and goals successfully, I wish you good luck. I think that I think this just requires a lot more back and forth dialogue with the client and the advisor myself to come up with a solid strategy that will work.
That's such an important point, Sage, and I'll just take this opportunity to just say one more thing on that note. There are so many DIY estate plans out there, and I will tell you that estate planning attorneys love them because people come to us to fix the problems. And I won't get into it. I don't want to get sidetracked, but I can share stories. I've caught mistakes that could have cost people $50,000 because they just didn't know what to look for or what doing certain things, the implications would be. So great point for bringing that up, Sage. Okay. And actually titling property is one of the things that people make massive mistakes on. Okay. So there are different ways to own property here in California. And what I'm going to talk about today is joint tenancy and community property with right of survivorship. So for most young families who own a home, it is their most valuable asset. And it's the very first thing that we make sure gets titled into the trust. When they sign their estate plan documents, they're signing the deed to the trust, which I recorded with the county. I'd say 98% of married couples come to me owning as joint tenants. And in joint tenancy, just so you know, that means that two people own the property and something happens to one, the other, by operation of law, gets to keep the property. It doesn't actually have to go through probate between those two tenants. But community property with right of survivorship has that same right of survivorship built in. The difference is this, and legally married couples in California can own as community property with right of survivorship. Registered domestic partners can too, but they don't get all the benefits of the IRS because they're not federally recognized. But so you have a married couple. If you own as joint tenants, and I'm first going to talk about the step up and then I'll talk about the creditor concerns. So step up in basis. So very briefly, if I purchase a house, obviously this isn't correct, but if I purchase a house for $100,000 and then I turn around and sell it for $500,000, exclusions aside, I'm going to have to pay capital gains on that $400,000 gain. If my mother buys a house for $100,000 and I inherit it at $500,000, and then I turn around and sell it, I don't pay any taxes because I got what's called a step up in cost basis. Her cost basis was 100. I got the step up to 500. So I didn't have to pay capital gains taxes. Okay. In joint tenancy, if one tenant dies and then the remaining tenant wants to sell, you're only going to get the step up on the deceased tenant's share. If you hold title as community property with right of survivorship, you're more like a unit. And so if one spouse passes, you get the full step up in basis. This can be, depending on how long property's been held, this can be massive, massive savings to do it this way. And for all the clients that own as joint tenancy, I actually do 2 deeds. It's sort of the gold standard to make sure that the IRS would honor it if you ever got audited. I actually do a deed from joint tenancy to community property with right of survivorship, and then a second deed from community property with right of survivorship into the trust. So you're covered, in both ways. The other downside with joint tenancy is people often, I see all the time, people will just add somebody to the deed. The minute you add someone else to the deed, you are increasing liability. If one of the people on the deed gets sued from a car accident, guess what's on the line? So we just want to make sure that people are aware of what the implications of holding title actually means now and in the long run. And so, yeah, do not add family members to deeds without very informed consideration. Okay, so Sage, what's another way to make sure families are protected upon a spouse's death?
So one of the most common gaps in a financial plan for a family that I see is simply not having enough life insurance coverage, also known as being underinsured. Think about all the things that we insure without hesitation: our cars, our homes, even maybe our iPhones. But what about our lives? Take for example, a young family where one spouse makes most or all of the income for the household. Again, if God forbid something happened to him or her, how would the children and the surviving spouse be able to live comfortably? I mean, the answer is they wouldn't, right? Or they should purchase some life insurance coverage. And now what happens if the spouse, so a separate example, what happens if the spouse, homemaker, which is arguably the most important job out there, passes away instead? Well, even though he or she may not have any income to begin with, there's costs in that as well, because you may have to hire a nanny and childcare costs and all of that. So it's super important to make sure, the appropriate coverage, we have that. And so the next question you may be asking is, well, what kind of life insurance is right for your situation? There's really 2 types of life insurance policies in the insurance world. There's term and there's permanent insurance. And I'll explain, how these work a little bit more in detail in a minute. But these are all amazing questions. How much coverage you need, what type of policy is right for you. And I'll say it really depends on many different factors of your financial and life situation. But it's something I advise my clients in the right scenarios to have this coverage and make sure they're protected and they understand how it all works. So term insurance will be cheaper than permanent because there isn't a cash value component. There is not. So term insurance kind of works similar to car insurance, which I think most people are aware of how that works. So you pay a premium. If nothing happens, then nothing happens. And that's the goal for life insurance, right? The goal is to not have to use it. But no one buys car insurance with the hopes of having to use it, right? It's there to really protect. And so the way I typically start my analysis with helping clients in this area is by reviewing any existing policies, making sure you're not getting ripped off on a policy you don't need. Unfortunately, I see that too often, and many individuals have huge, expensive whole life policies that they simply do not need. And while it may help, a permanent policy like that may help supplement retirement, I don't view that as, life insurance as the end all be all. At the end of the day, I really view it as insurance, which it is. And so it's very important to understand that. And in addition, just to cover some misconceptions, almost everyone has a policy through work or some sort of option to opt in. And that's great because on the positive, it's cheap. At least you have some coverage. But however, on the negative, the amount of coverage is typically not nearly enough that you need. And you don't get to keep that policy if you leave your company or decide to retire. So let me walk you through how I think about this and the sort of needs analysis approach that I take. So let's use an example. We have a married couple around the age of 35 that lives in LA. And let's say they make $200,000 a year combined. They have 2 kids and they have a $500,000 mortgage balance. Okay. Is their coverage for, let's say 2 times salary, so $400,000 through work enough? Absolutely not. They likely need over $1 million in term insurance. And again, this depends on some other factors, but in that scenario, you want to make sure that your family will be protected and again, be able to do all the things that they want to do and continue doing that. So when I have a client that, is approved, we have the proper policy in place, we got the right planning done. My clients and I can sleep comfortably knowing that in the tragic scenario of something happening to them, their beneficiaries would receive a large amount of proceeds completely tax-free. And so I think that's very important, a very important part of everyone's plan. So Ariane and I are here, we're all about helping you protect your family. And this is a big one that many can prepare better for. So Ariane, what's another vehicle that can allow money to be passed along tax-free?
529 college savings plan, and we definitely have one for Mateo.
Awesome. You got it. So that's exactly a 529 college savings plan. So this has become a lot more popular these days as a way to fund kids' college education, and also can be used as building generational wealth for estate planning purposes. So parents, grandparents, and anyone's contributions are basically unlimited, although gift taxes can apply. So what's called the annual exclusion is about $17,000 per person per beneficiary for 2023. And so the plan is pretty flexible as far as switching beneficiaries, and contributions to a 529 plan are removed from your estate, therefore reducing your potential estate tax liability. And this can be very, very beneficial for a wealthy family looking to pass along assets, and again, with the primary goal of saving for your children's college education. And in some states, not in California, unfortunately, but in some states, you can receive a tax deduction for contributions made into a 529 plan. So the best part about it is that your earnings grow completely tax-free if used for qualified educational expenses. These can be things like tuition, room and board, books, and other related expenses. Also, private K through 12 school up to $10,000 a year. It would be a qualified expense. So think of it like the Roth IRA for your kids' college. It's amazing. And I want to give you an example of how powerful it can be. So let's say you put in $5,000 into a 529 plan the day your child is born. What a great gift. And you just contribute $100 a month until they turn age 18. Assuming a 6% annualized compounded growth rate on the investments, your kid would have a little over $50,000 to use for his or her education, completely tax-free as long as it meets those some of the 529 plan rules. And so in this case, their tax liability was reduced by about $23,000. And this is an amazingly tax efficient account. And you may be thinking, one of the most common questions I get is, well, what happens if your kids, they get a scholarship, which I know with everyone out there, we got great genes in the family. I'm sure they will. But what if they decide not to go to college, right? What are your options then? And so those are oftentimes the conversation I have about 529 plan. And feel free to drop the question in the chat for a Q&A coming up. The answer to that question is, I'll just say, is not as daunting as you may think. And there are some exciting new rules that favor those who use a 529 plan. So Ariane, wrap us up with how we can protect our beloved kids.
Yeah, great. Thank you so much, Sage. Okay, so we've talked a lot about making sure our kids are set up financially through life insurance, 529s, and again, remember, ensuring that any of those assets flow through the trust. But we haven't yet talked about what, for many parents, is of paramount importance. Who would care for their kids in an emergency, and who would raise them if they couldn't? So many parents think, oh, well, our families know who would raise the kids. But I have a story that underscores the importance of legally naming your long-term guardians. And there are so many stories out there, but this is actually a friend of mine. When kids were young, she realized that if something happened, they didn't have anything in place. And that her sister-in-law on paper was absolutely the person the judge would have chosen. She was married, had kids of her own, a stable job. Everything looked like checked out, like that she would be the most stable parent. On the other hand, my friend's sister wasn't married, didn't have a stable job, lived a very bohemian lifestyle, traveling all the time, but was 100% the person that both she and her husband would have wanted to raise their kids. The sister-in-law had a toxic relationship with her husband. The kids were messed up as a result. It wasn't a healthy environment. And had something happened, and thank goodness it didn't, but a judge never would have chosen the sister. They would have chosen the sister-in-law. So the moral of that story is you do not want a total stranger as a judge deciding who would raise your kids. You want to have agency over that decision. Okay, so as I mentioned earlier, traditional estate planning just had parents name long-term guardians in a will. But that is only a start of what I do to make sure that there are no gaps in the planning. So so what we do is we have a separate standalone document for naming long-term guardians, and this would work in the event of both incapacity or death. We also name short-term guardians. So for many of us here in California, our families might live in other places. I know for me, that's the case. And so what we do, and even if our families live next door, they could be traveling or stuck in traffic or whatever the case may be, and might not be able to be there immediately in an emergency. So one of the other things I do is have clients name people who could be there within 30 minutes, friends, neighbors, family members who could be there with the kids, have legal authority, even, adult babysitters or nannies, someone the kids feel comfortable with, so that if you didn't make it home, the kids would never be taken out of the home and into protective custody. As a parent, that is, if there's a traumatic situation going on to begin with, you don't want to double down on the trauma by taking them out and putting them with strangers. Another thing is, like in the example I just shared, Clients sometimes have people they would never want to serve as guardian, a family member that they think would not be good for a multitude of reasons. What we can actually do is called the confidential exclusion of guardian. So we have a legal document that identifies who you would not want to serve, and we can also list the reasons why. It's sealed, and in the event that person ever contests your guardianship choices, it can be opened up and shared in court. And chances are that person who's contesting it would not want that document shared in public court. Two other things that I do for clients with minor children, we have a medical power of attorney for the kids. So in the event that you are unable to speak with doctors, make medical decisions for your kids, you authorize both the short and emergency guardians the ability to do that. Okay, so they can stand in your shoes as parents. Also, even if you've named a long-term guardian, a judge has to formally appoint that person to be the legal guardian, and that can take months. And so this care power of attorney, it's a power of attorney that empowers the people you've named as long-term guardians to register your kids for school, open their mail, essentially do all the things that parents or legal guardians can do. Another thing I do for parents is I give these little wallet ID cards, and I wish I had one right here, but it's basically a card you can keep in your wallet with the names and numbers of the people, the short-term guardians. So in the event you're in an accident, God forbid, and you can't speak, and they're looking through your wallet, they know who to call. Another thing that I do is I really encourage parents to fill out these worksheets that I provide to both their guardians and trustees. So again, the guardians are the people raising the children. The trustees are the people managing the assets. Sometimes it's the same person. Sometimes you think different people would do better in those roles. And you're giving guidance to them. For the guardians, parenting philosophies, types of education, and on the trustee side, how you'd want the assets used. So it's really in alignment with your values. What kind of school do you want them to go to? What sort of travel do you want to pay for? Would you pay for a wedding, a business, all those kinds of things. And then finally, my absolute favorite part of the whole process, once we have the legal and financial stuff in place, I do recorded interviews with my clients. So of course, this is about passing down legacy, and a lot of that is financial and making sure that all of that is squared away. But to me, no estate plan is fully complete without passing down your personal legacy. And so I send clients a whole bunch of questions ahead of time, and they pick maybe 5 to 10 that resonate most, and we'll spend up to an hour talking about their own, whatever they want to talk about, their own childhoods, their love story, what it's like having young children, what are their hopes and dreams for them. And the idea is that, you know, they're going to, and then I do check-ins with my clients every 3 years, and we can do short interviews at those points. So the idea is that you're building this library of legacy that hopefully you'll be, you know, eating popcorn and watching with your grandkids one day. So it's really, what this is really all about is passing down our love, our care, our legacy through all the means that we have at our disposal. So with that, I'll pass it back to Sage.
Yeah, thank you everyone for attending our webinar today. We know there was a lot of content out there and simply not enough time to go over everything that we'd like to teach you. So we have so much more, as far as what we can share with you. And so the next webinar, what we'll be going over is more complex planning and diving into other topics such as estate tax and life insurance, trusts that can, remove assets from your estate. And in the meantime, Arian and I invite you to reach out to us for a conversation. We would be happy to extend a free consultation if you haven't already, to get to know each other and put together a comprehensive plan for you and your family's specific circumstances. It's worth, I think it's worth noting that the client experience and overall financial and estate planning can really be enhanced when your advisor and estate planner work closely together. And so, as you can see, we're younger, comprehensive planners, and the nice part about that is we get to grow together with our clients and hopefully be there for the next generation as well. With that, again, thank you for listening to my sage advice and Arian's wealth of knowledge. We'll now open it up for any questions. It looks like I just got one question.
Sage, real quick, before you do that, sorry to interrupt. If you go to the next slide, we have, just to follow up, we have QR codes. And there you go. We have QR codes so on the left for both of us is our LinkedIn profiles, and on the right for both of us are links to our consultation calendars. And actually, I'm unable to put it in the chat, but I think our host is going to drop the links directly in the chat too. So I just wanted to point that out. If anybody does need to drop off before the Q&A and you do want to continue the conversation with either of us, you can use the QR codes or check out the chat in just a moment. Sorry, Sage, to interrupt. I just wanted to catch you before you.
No worries. Thank you, Ariane. Super helpful. So let's see here. We have a question. Second.
I know we're having some chat weird things. Bear with us while we're working this out.
Here's the question. Really directed towards Ariane, so I'll ask it here. The question is, my partner and I won't be having kids, but we will be the guardians of a person with a special needs someday in the future. And so the question is, what is the right move for us right now? And what are some milestones we should look towards for the future and planning purposes? So I'm not sure if that's a question you can answer on the spot, Ariane, but I'd read it to you aloud.
So I can, okay. So without knowing more about whether this person's a child or an adult or all sort of the specifics, I will say from a non-legal perspective, I would say the communication with whoever is in charge of this person now, really understanding what this person's abilities, needs, benefits that they receive. Since it's not so typically the special needs work that I do is working with parents who have minor children with special needs. And so when assets flow to them, they flow into a special needs subtrust. I don't actually do standalone special needs trusts, and I certainly can refer those out to wonderful people. But I would, without knowing more, I would say in this instance, definitely this person should have a special needs trust set up for them, because that is a really critical importance. As I mentioned earlier, if a special needs person inherits assets outright, it can jeopardize really important benefits they might be receiving. Also, with these special needs trusts or supplemental needs trusts, there are very specific regulations about the use of the assets. So you definitely want to be working with somebody who knows how to manage those. There are professional fiduciaries out there that can do that. But for right now, it sounds like really just having a really good understanding of what is to come down the road. And I hope that answered your question. If we were chatting one-to-one, I'd ask you more questions, but for the sake of time, I'll move on to the next one. So go ahead, Sage.
That is a great question. I think the biggest part about that is just making sure that we don't jeopardize any benefits that the special needs may be already receiving. So very important, and a lot of planning to do with that we can certainly help out with.
Oh, Sage, okay. It looks like there's something here for you. And again, I think this is just because we just put our consultation up. What does your consultation and onboarding process look like?
Yeah, I'm happy to answer that. So basically what I typically like to do is set up a time to dive into your situation. And this is more of like a discovery meeting to get to know you and what your goals are. And I also provide like a lot of education in that meeting, and give you some ideas and advice that you're looking for. But it's really to gather all the information so that I can give you a more comprehensive plan and then deliver that to you. And once we go ahead and implement the plan, I give all the advice you're looking for. We run through the numbers, how we can reach our goals, how we can save money on taxes, all of those amazing things, what type of accounts to use. Then we go ahead and implement the plan. And then once we implement the plan, so for some, that means I deliver the plan to them and they implement on their own. But the majority of my clients, they want to work on an ongoing basis so they can continue to receive that support and advice along the way as they make, their big decisions. And I will be managing the assets along the way for my clients, depending on their goals, right? So we may have different buckets of goals, from retirement planning to buying another property to saving for their kids' college. And those, the asset allocation and where that money is placed is very different for each goal. So I would be continuing to monitor those, make adjustments as we go, and check in. Some of my clients, we like to review quarterly, do quarterly check-ins. Sometimes, it's only a couple times throughout the year, but I'm always available for my clients whenever they have a question, things that they're thinking about, even something as simple as like, hey, should I buy or lease this car? What are your thoughts? And so I'm here to be a resource and a sounding board for all of my clients. So that's how I like to work. Yeah, we do. Ariane, this is great. We have a lot of questions coming in here. I got one for you. It says, it reads, what are the first steps for setting up a revocable living trust, and what steps take priority over others?
Okay, great question. And I'll kind of just dovetail off of just the process for me. So the steps would be, I love having initial consultations with clients. I do these free 30-minute consultations, and the idea is that so the first step would really be for me to educate you a little bit, but now you've been educated today, and for me to get to know you a little bit and understand, what your primary needs would be. And then I set up a 2-hour planning session, before which I have prospective clients fill out a detailed intake form that identifies your goals, all the people you think you might want to serve in the various roles, and all of your assets. And from there, at that planning session, the beginning part of that session is I do some more specific education on what probate would look like for you based on your assets. We talk about estate tax a little bit, and then we dive in and design the plan. And so when I talk about the plan, it includes the living trust, the pour over will, the various documents I talked about, and we do them all simultaneously. So really the first steps are gathering all your financial information and all that. And then just in terms of process, about a month after that planning session, the documents are prepared for your sign. We review them together, you sign them, and then that's when the whole funding process can begin. And again, that funding is putting the assets in. But so in terms of any one step taking priority, it really all kinds of moves ahead at the same time. But that first step would really be just gathering everything so that we can push everything through. And it's a pretty easy, I will say, one of the best things I hear from my clients is, I thought this was going to be so hard and you made this really easy and flow. So
that's amazing.
That answered your question. And if you have any more questions, again, feel free. Maybe we can actually go back to the QR code slide. Sure. So that for a moment, in case somebody didn't catch it and they want to go ahead and book something.
And I just want to say I have a couple more questions that came into the chat. If you're done there, Ariane.
Yeah, go ahead.
So question is, I understand there's a short-term tax avoidance opportunity available now, allowing me to front load a 529 plan of $170,000 and not be responsible for paying any gift taxes, even though the current limit is $17,000. Great question. So the way that it works is when you front load a 529 plan, you can do up to 5 times your limit. So you basically, in the future, 5 years that you were going to be contributing maybe 17,000, you front load it all into 1 year. And how this person got to the 170,000 is we times that by 2 for a married couple, and then we times that by 5 for that married couple. And so 34,000 times 5, 170,000. And that money gets out of your estate because you technically are gifting it, even though you are the account owner of a 529 plan. And you would not be, as long as you file the right forms, you would not be responsible. And by the way, the forms for gift taxes, the form 709, and you'd have your accountant do this. And even though that current limit is 17,000, you actually would not assuming you didn't make any other gifts, pay gift taxes, because the way that it works is anything above that would just start eating into your estate tax exemption, which this is what we will be kind of diving in more to next time on our next webinar. But for this year, it's set to sunset in 2025, but this year it is 12,920,000 for an individual. So you could times that by 2 for a married couple. But that is how you could front load a 529 plan. Great estate planning strategy, especially if you have lots of assets and you're looking to maximize your kids' college, or maybe even grandparents. So and then just kind of a follow-up to that, may want to highlight to the group how a 529 plan can actually be withdrawn for 5 years in the event child chooses not to attend college. Again, this is what I was saying is one of the most, I guess, hot questions that I get is, as soon as I mention a 529 plan used for college, we go, wait a minute, what happens if my kids don't go to college? Or let's say we don't even want them to go to college, they're on a different path. The way that would work is, let's say you put in money into the 529 plan and you made money, so the earnings grew your 529 plan. If you wanted to pull that out, you still can. You just would have to pay taxes, just like a regular investment account works. But there's a caveat, you would pay a 10% penalty as well. So that is how that works. There may be some follow-up questions for that as well. But yeah, great, amazing questions that we're seeing come in here. So hopefully that answered them. And I don't know if Ariane has anything else to add, but I think
I know it's 1 o'clock and we promised we wouldn't take up your time. I do just want to add one thing that I realized it didn't really touch on. I talked about how without a living trust that kids would inherit everything at 18, but with a trust, and I'm sorry to bring this up earlier, you can dictate how and when your kids get the money. So oftentimes parents will say, a portion at 25, a portion at 30, and a portion at 35. A lot of parents even choose an additional layer of protection where you can leave assets in trust for your kids' lifetimes. So if they ever get divorced, if they ever have creditor issues, it's actually protected for them in that trust and out of their estate for estate tax purposes. So at our next one, we can dive into that a little bit more, but I did just want to make that point that a trust gives us so many more tools than you'd have without one. Right. Sage, unless there's anything else you want to say, we don't want to keep you all. We know it's a weekday, but if there's anything else you want to say, please go ahead. And otherwise, just thank you all so much for coming, and we hope that we imparted some useful wisdom.
Have a great day, everyone. We'll see everybody next time. Thanks for joining.
Bye.